Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today is Clark Briner, founding partner at Revere Capital. Clark, it's great to meet you virtually, at least. Thank you for your time. Really looking forward to our conversation.
Todd, great to meet you today. Thank you for having me.
So, you've started your career across private equity, investment banking at a large international bank, real estate investing. Ultimately, what gaps did you see in the market that led you to found Revere Capital?
So I founded Revere Capital about 20 years ago after having spent some time in investment banking, private equity, and the private credit space. And really what we do here at Revere Capital is focused on asset-backed lending in the lower middle market. And so that's the area that we have found where it's an area that's really too small for the institutions and the large credit funds to target. And also equity, which oftentimes does play in this space, is just too expensive for the entrepreneurs and proprietors that focus here. What our borrowers typically need and where we compete is on speed and certainty and then creative structure. And neither banks nor the larger funds are able to approach that and provide that service to these entrepreneurs.
So bridge lending, specialty finance were once obviously considered niche. I think today they've grown, obviously over the last 20 years, especially post GFC. What gave you that conviction early on before it became obviously a strategy that many funds, even the larger players, are kind of at least have teams or funds within their overall structure that play in these spaces?
I think you hit it spot on. When we started this firm 20 years ago, there were very few players in the space, real estate lending, real estate bridge lending, as well as the specialty finance space. And all the big names are now into both of those. Where we differentiate or compete there is the lower middle market, speed, certainty. And one thing that we always focus on is asset-backed credit. In the market, when people talk about private credit or direct lending, they're generally talking about cash flow lending. And cash flow lending is a whole different business than asset-backed lending. Different credit profile, different recovery, success, etc. It does go back to in the bridge lending and especially real estate bridge lending and especially finance space. The inefficiency in that lower middle market is structural. It's not cyclical. And so what you're seeing is a lot of funds that focus on, they come into a market when it's hot and then they leave when it's not. That is not an area that we like to compete in. It's the areas that have permanent dislocation because of the structural inefficiency. And so to compete where we compete, it takes hands-on underwriting, access to the origination, and really the complexity creates the opportunity to create alpha for our investors.
So the definition of middle market, even lower middle market, how would you define those today, and how much have they changed since you founded Revere 20 plus years ago?
Great question. It has definitely changed over 20 years. Right now, the lower middle market is, I would put in that $5 to $50 million space. When we started this business, the larger funds in the space may raise $500 million. Now the larger funds raise 5, 10, 15, $20 billion.
Yeah.
And so, as you can imagine, when you raise a $5 or $10 billion fund, you can't write 30, $40 million checks and effectively put that money to work. And so the lower middle market has shifted upward and has gapped out. So we have a much larger pool to play in. I jokingly say where we play is too big for the country club syndicates and too small for the institutions. So that's really the $5 to $50 million space, both in the real estate bridge lending and the specialty finance space. The capital has become very concentrated at the top as well, where the opportunities have not. The opportunity for alpha is below that $50 million threshold, where there's not 15, 20 very large, well-capitalized funds arguing over basis points. How low can we go? How much structure can we give up to win the deal? That's just not what we try to do here at Revere.
So looking back, was there any particular, lessons early on? I mean, obviously a few years into Revere came the GFC, but was there anything particular that happened back then that still influence how you structure loans or transactions or deals today?
Absolutely. No one's been in the investment business for 20 years and not learned a lot of good lessons.
At least you
You
hope so.
know, you know, I think it always goes back to there's a temptation to stretch for yield and return, where in reality, you should focus on structure. Structure matters. And I always go back to Warren Buffett's quote about investing. Rule number one is don't lose money. Rule number two is don't forget rule number one. And so, control and alignment really matter in investment, and that's with your borrower in our situation. And if there's good alignment, there's good structural downside, and you're always looking for not just how is the borrower going to get out, but if things go wrong, what are option one, option two, and option three? And you have those road mapped out before you make the investment. Generally, it's going to turn out well. I always say, the bad structure turns good assets into bad loans. And so structure matters.
So, to maybe piggyback on that a little bit, obviously you've deployed, I think it's been 2 billion over the 20 years across your fund, something along those lines.
About 3 billion now. So
okay. There you go. How do you think about, differentiation, and then, as more competition comes in, more capital floods into the space, does any of that, how do you avoid like compromising on some of your standards? Because you'd have to think money's flooding into the market, competition's flooding in the market. How do you still stay with where you want to be? And how do you not change?
I think it's consistency and not having style drift. What you'll see in a lot of managers is style drift, because whether it's a hot new idea or they get flooded with new capital and they need to deploy it in a certain period of time. So we've really focused on discipline, and we've stayed consistent to the asset-backed lending space, the recovery first mindset, and then we have vertically integrated all origination, servicing, and workout in-house, which is atypical in today's world. The amount of capital that we raise funds that are middle market appropriate. So, $500 million. We're not raising $10 billion funds trying to put out $5 to $50 million checks. And so it's really just staying focused on recovery and downside protection. And we've been doing it for 20 years, and it's worked. And so I think that's the lane we're going to stay in.
How do you think about liquidity versus duration risk in today's market?
Liquidity, I think, is an underpriced situation right now, as we're starting to see in that direct lending or cash flow lending space. The larger managers and really all of them, the BDC space in particular, they have those 5% caps on the investors getting out. Some managers are doing a great job selling assets and getting through that, but underpricing liquidity is definitely a problem. You have to look through to the underlying investments. So if you're an LP, someone says you have quarterly redemption. Well, if they're writing 5 or 7 year loans, you can't give you quarterly redemptions with 7 year loans, obviously. And so at Revere, we really focus on the underlying portfolio, focusing on the duration so that we can provide that quote unquote liquidity. We're writing 6 to 18 month loans typically. And so there's a perpetual turn of the loan portfolio. And that allows that constant evolution and turning not only helps your risk and your downside mitigation by being able to reprice or add covenants when they have to come back for extensions. But in the case that an investor needs liquidity, it's much more near term than longer duration loans and funds.
Just to follow up on that kind of question in today's market, do you think some of the issue happening today has been a bit of an education gap from the investor into the fund or some of these structures where it's like, hey, I thought I was getting this, but I'm not getting this, and whether it be an education gap on the investor or maybe by the manager, but there seems to be a bit of a gap in what people thought they were getting.
That is true. I mean, there's always two sides to the story. You ask the lawyers and you ask the GPs or the managers, it is clearly laid out in that 800-page document that you signed. The problem is no one really reads that document. And so they read the 1-page tear sheet, which is fair, and it says there is monthly or quarterly liquidity, but they miss the footnote that says there's only 5% per quarter. And so what we're seeing is pretty typical in the retail channel. When the tide turns and the tide starts going out, it goes out quickly, not slowly. And so that 5% cap is making it, the GPs are doing exactly what they said they were going to do. So you can't blame them. But there is an education where maybe the GPs could have educated their LPs a little bit better on that 5% cap.
So if we look at specialty finance, and obviously it's expanded quite a bit the last few years, and even over the obviously since your inception, are there any particular subsectors that you believe are mispriced or maybe misunderstood in today's market?
The specialty finance, that's a very large market, over $1 trillion market. We do focus on one silo called rediscount lending or lender finance. So we're making senior revolving loans to other boutique lenders across a lot of different verticals: consumer, merchant, commercial, litigation, media, royalty, leasing, etc. And so where we find the best opportunity, again, we focus with downside protection and then start talking about yields. And so specialty finance is especially appealing to us because you have large, diverse pools of homogeneous assets that are very short duration. Longest underlying asset that we're looking at in the specialty finance space is about 9 months. In the consumer space, some of those loans are 2 or 3 months long. So you have really good liquidity, and you have hyper diversification, as in thousands and thousands of underlying loans in those collateral pools.
So when you think about, kind of the difference between structural alpha and cyclical opportunity in today's market, how do you differentiate?
I'll go to the specialty finance side. The structural is why we are in the specialty finance space. The cyclical or the market is those verticals that I laid out before. We will allocate heavier to one versus the other depending on the market opportunity. But the structural opportunity stays consistent because it is structural.
Yeah.
Where we may be more weighted towards business lending, or we may be more weighted towards consumer, or litigation finance. We've started pulling back from that area as more and more capital has flown into it. So both is what we look at, but we're not going to take on an investment strategy that's not born out of structural inefficiency.
And do you see any, I guess, cascading impacts from the direct lending and, as you say, the cash flow lending market kind of beginning to come down to where you guys play, or is there just too much of a differentiation between those markets where you play? Like, do you see any cascading impacts, as this potential credit, incident or credit period continues to evolve?
Todd, you mentioned the word education earlier. And so we are spending a lot of time educating the market and our consumer, our investor base, the difference between cash flow lending and what's happening in that space and asset-backed lending. There has been a huge amount of capital flows that have gone into cash flow or direct lending, and there has not been an inordinate amount of flow into the asset-backed space as of yet. And so you can't have huge inflows, as in billions and billions and billions of inflows, in a market not grow proportionately. And so I can't remember the last statistic, but the market has grown, 100% over the last 5 years in the cash flow lending space, but the capital flows have grown 500% over that same period of time.
Yeah.
And so we all know that when you have that amount of cash flows, you either have to lend more money, take on more risk, or you have to compete in a way. So it's pricing, structure is really how you compete. The ultimate commodity is cash, right? And so it can go to different places. Where the asset-backed space, where you focus on the recovery, we have assets that if something goes wrong, we're going to be able to take those and monetize them and get our money back. So we're really focusing on education, but the structural difference and the risk difference between asset-backed and cash flow, and then also the capital flow difference is meaningfully different between the cash flow space and the asset-backed space.
Speaking of the consumer, you mentioned the LPs. What are they asking you today that maybe they weren't asking 3, 5, even 10 years ago, given that you guys have been around for 20-ish years?
20 years ago, people were asking me, have you ever heard of a bank? Aren't they the ones that lend money? And so that was before we were one of the first people out there in the asset-backed space. And so we were a little bit just new to the market. And so we got all kinds of kind of sarcastic questions. The market is educated, and now it is a mainstream asset class, which is terrific. So you're not having to answer that question anymore. But 3 and 5 years ago, the investor was focusing on, what's your 3 and 5 year track record? What have the returns been? And now they're asking you, what are your losses? What are your downside protection? What's your liquidity? What's your correlation of the greater market? So the challenge is you shouldn't be asking one or the other. You should be asking both at all times in the market. And as we're starting to see the tide going out, people are starting to focus more on the downside. So overall, it's just more focused on risk management, and the LPs have moved from return to risk.
So do you think we're heading toward, a convergence between real estate credit, specialty finance, asset-based finance?
That's funny. It's a great question, and absolutely. What you're seeing is the asset-backed lenders are learning a little bit from the cash flow lenders, and the cash flow lenders are learning a whole lot from the asset-backed lenders. And so you are seeing a convergence in covenants, in cash flow requirements, control provisions. Everyone is becoming everyone's becoming asset-based from different perspectives in different directions is really what's happening. And so more and more are falling into that hybrid world where they have cash flow covenants and components, as well as they have pools of assets of some sort backing up the collateral.
So data and technology, obviously, we've heard, a lot about it. The rise of AI, Obviously, a lot of systems are different today than they were 20, 30 years ago. How do you guys think about the importance of data and technology in scaling credit platforms?
It's absolutely essential in today's world. Just from human capital, time, and cost. I'll give you a little example, especially finance side. When we founded that about 10 years ago, there was no AI, there was no data analytic, or very little data analytics. And part of the, especially finance, is you're making sure that everything's ticking and tying the general ledger to the bank statements of each individual lender. And that would take us 24 to 48 hours and a couple analysts ticking and tying before we were able to do a draw on their warehouse facility. In today's world, I have no analysts, and it's done every millisecond by APIs burrowed into their ERP system and into their bank account, instantly ticking and tying everything. And the computer will tell us instantly if there's a misalignment and shut down all banking activity. And so credit has gotten much better, or risk has gotten much better because it's real time, where before we'd get monthly and worst case quarterly financials, and we were always behind the eight ball. And so if you are not doing that, you'll likely have a higher fraud incidence, which is the greatest risk in the credit world, obviously. Where technology can't compete is judgment and experience. So no matter, at least to date, we have not seen an AI agent that has been able to share experiences, ask more thought-provoking, in-depth questions in investment committee that looks, it's helping expose bad credit through just the amalgamation of huge amounts of data, but it can't provide the judgment, insights, and experience that experienced humans can.
You think someone's going to try that at some point? Like, hey, we're a credit platform and everything's going to be automated, whether or not it works. But I do foresee someone at least trying it.
Absolutely. If you don't try it, because I'll even use our experiences, we have started to build an investment committee AI agent, if you will. And just to test and beta test, it's not an official vote on the committee, but it is giving you and giving the originators and the underwriters who are putting together the memo very thoughtful, in-depth questions that they need to go answer and get structure ideas, covenant ideas, and stuff of that nature that an AI bot is bringing to them before it even comes to investment committee. So the memos are better, the structure is all better by the time it gets to us.
So if I gave you $1 billion to deploy today, where would you not invest that money?
I think the first answer that came to mind is long duration mark-to-market assets. The market has converted a lot into the alternative private space that is making longer duration investments, and they're marking them to market. And it's just hard to do that in an efficient manner. Also another way, unsecured credit and covenant light is becoming more and more prevalent because of the cash flows that are coming into the direct lending space. When they always say, when the tide goes out, you see who's swimming naked. And I think we're in that period right now that the tide is going out, and we're starting to see who raised a lot of money and maybe didn't think about the downside of deploying it in a manner that didn't focus on the recovery first. So anything, I guess, punchline would be avoid anything relying on market bailout or market exits versus asset or monetization exits. If you're relying on the capital markets to get out of an investment, that is not a trade that I would be willing to do right now.
So we have just a few minutes left here. I always like to end a little bit more lighter and with some funner questions. So first one is favorite sports team and or hobby.
See, I would go pretty much any Dallas sports team. The Dallas Mavericks. Love the Cowboys. The owner challenges me personally, but grew up a Cowboys fan. What do I enjoy? What are my hobbies? Love to ski, love to travel, love to see the world and new cultures and new experiences, just learn from different perspectives.
Tell us one surprising thing about yourself.
I'd say on the business front, I'm an anomaly in that I love the deals that go wrong. Everybody else tends to like the deals that go right, but it's such great learning experiences. And one of, I guess, my superpowers, things I enjoy, is solving very complex problems under pressure.
One book that you would recommend reading.
Ooh. I'm going to go with one I read probably every year and a half to 2 years. It's called Never Split the Difference. And it's a negotiation book written by the former head of the FBI negotiation or hostage squad. And it's just fascinating, the mindset and the research they've done into negotiation.
Most exciting part of your job.
You can reference it just a bit. It's the solving complex problems in real time. And then also, the reason people borrow from us is because we are able to provide structures and opportunities to people that banks and the larger can't. And I love to see people successful, and whether it's a real estate project or a specialty finance lender, that they're able to grow and monetize and feed their employees and grow their business.
As an aside, as a follow-up to that question, how many, it's probably hard to quantify, but how many businesses are there today that exist because of, non-bank players like Revere and others who filled a gap that the banks obviously left post GFC? I mean, there's got to be hundreds, if not thousands.
Thousands. When you think about the quantum of capital over the last 5 years that's come into that direct lending space, for example, I mean, just at Revere, we've had 500 borrowers that obviously couldn't get access to bank capital, whether it was the structure, whether it was the deal, or what it may be. They wouldn't have been able to do that project or grow their business without a Revere or someone similar to Revere helping them do that. So it's a terrific space. It's become mainstream, and it's definitely a boost to the economy.
Final question is one prediction for the next 12 months.
You're going to have a lot greater dispersion in the credit markets over the next 12 months. You're going to see a greater separation of the wheat from the chaff, if you will. The people that put a bunch of money out in 22, 23, 24, those 3 and 5 year loans that are coming due, that maybe weren't as thoughtful on their covenants and the recovery as I think they'll learn they should have been. So,
well, I think. Go ahead. Did you have any final thoughts there?
I would just say that the dispersion in results, and I think that you'll see some credit providers possibly going away, and you'll see, just a greater dispersion.
Well, Clark, I think that's a good place to leave it. So thank you first for your time. Really appreciate the conversation. I had a lot of fun, and continued success to you and the team at Revere.
Todd, it's been great. Thank you for your time today.
Of course. Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.